Good morning, everyone. Welcome to today's webinar. This morning, I'm really excited to be able to introduce to you our newest fund, the Sygnia China New Economy Equity Fund. For those of you who don't know me, my name is Monique, and I'm part of the investment team here at Sygnia. And just before we get started, I just want to mention that the webinar this morning is being recorded. If you miss anything, you can take a look at it again on our website afterwards. And then there is a Q&A box at the bottom of your screen. And if you do have any questions, you're welcome to pop them in there. And we'll try and get to them at the end of this webinar. Right, so to start off with and to kind of frame today's conversation, I wanted to start on this slide, which gives a really nice overview of our global balanced fund structure. So in our global balanced funds, we use what is called a core satellite approach. So we have a larger core to these funds, which consists of highly liquid, well-diversified funds. These funds follow a strategic long-term asset allocation and may take shorter-term tactical positions as we see opportunities in the market. But then sitting alongside our core portfolio, we have these kind of thematic satellites that sit alongside and create uncorrelated sources of alpha. Some of the satellites that we have in the fund at the moment include a disruptive tech satellite, obviously harnessing some of the growth in tech and innovation over the last few years, and obviously a great place to be kind of just with the future and the way that technology is going. Then we have a global real estate satellite. We have a value satellite, kind of harnessing the switch from growth to value that we saw kind of ramping up towards last year. We also have a health innovation satellite, which is a great thematic area that we believe will do well into the future as kind of your developed market populations age, government spending in healthcare increases, and we're also really excited about innovation in the space as well. And then number 5, we have our emerging Asia satellite. And this is kind of the focus of today's webinar. Within emerging Asia, we have an emerging market exposure. We use funds such as our Emerging Market 50 ETF, which has a high weight towards emerging Asia regions. And then we also have a standalone China allocation in our funds. And that's really where this new fund fits in. It focuses on the Chinese economy. And we're quite positive about this area of the market at the moment. China's shown amazing growth over the past few decades, although growth might be slowing somewhat or is expected to slow somewhat. Government is still supporting growth and innovation, and the economy is advancing, moving more from an emerging market to a developed market. The government has signaled a strong focus on economic stability in the region, and we also favor China in the spirit of innovation. Just as an example, about 6 of the top 8 patent holders worldwide are Chinese companies. The number 1 spot actually goes to another emerging Asia company, Samsung, based in Korea. And all the way at number 8, we have IBM, the US company. We do, however, think that in the case of China, it's all about where you are investing, and it's important to know what you're investing in. And that's kind of the basis of this fund. We focus on the right kinds of sectors that we expect to do well from China's new growth path, and those sectors that we believe will sit on the right side of government's focus and regulation. So the fund has been launched. It's available on the Sygnia Alchemy platforms. It's available as a unit trust. We are also in the process of launching an ETF along similar thematic lines. And we're also in the process of finalizing an application to launch the fund as a UCITS fund denominated in USD. So just taking a look at China's economy, it's the second largest economy in the world behind the United States and has shown exceptional growth over the past 4 decades or so. Growth has been about 10% year on year over this period, and China's been able to lift over 800 million people out of poverty and into the middle class. China accounted for 37% of the world's total economic growth between 2010 and 2019. So it's just an amazing growth story, and it's often called an economic miracle, just speaking to the size of growth over the past 4 decades or so. However, historically, growth has been based on highly resource intensive, high volumes of exports, and all on the back of low paid labor, which has obviously been a strong driver for growth and created the economic superpower that China is. But it has also resulted in a number of economic, social, and environmental imbalances. So now what we're seeing with China's economy is that they're addressing some of these rebalances, and growth is shifting now from that high speed growth model to a more high quality, inclusive growth. Along with this, we're seeing a real shift in the Chinese consumer. The middle class is growing and household incomes are growing quite rapidly. So along with this, consumer spending is reaching all-time highs. Then just again, speaking to the growth in China and also in the emerging Asia region, the graph on this slide shows emerging Asia in yellow there, and it shows the region's share of global GDP. And you can see how that's just been expanding over the past few decades, and that trend is expected to continue well into the future. Then looking at China's equity market, so it has the second largest equity market in the world, valued at a market capitalization of roughly $18 trillion. So really, really large, just behind the US equity market. China represents the largest portion of the MSCI Emerging Market Index, and this is also expected to increase over the coming years. But despite its dominance in the Emerging Market Index and despite its size, it's still relatively underrepresented in investor portfolios and quite underrepresented in broad market indices such as your MSCI All Country World Index, and actually also when you take the full China economy into account, actually quite underrepresented in the MSCI emerging market as well. So analysts believe that the allocations in these major benchmarks will increase in the next few years, and some accounts will have predicted that China should represent over 40% of the emerging market index over the next 5 years, and roughly a fifth of the All Country World Index. So China is currently classified as an emerging market, but actually, is starting to sit somewhere between an emerging and developed economy. And we believe that it'll, eventually wind up amongst developed regions, particularly as its capital market opens up further and GDP per capita increases. But along the road to becoming a more advanced economy, structural reforms are required. And we already saw this starting to take effect last year. And if you've been following the Chinese equity market over the past year, you'll know that 2021 was a difficult year for Chinese equities, particularly the offshore tech stocks. And this is largely a result of these reforms being implemented. A lot of the initiatives that were taken last year aimed to clamp down on anti-competitive behavior, diminish materialism, strengthen national security in China, and bring data protection and privacy under control. So just some examples, we saw Chinese tech giants being slapped with a number of fines. Some of those fines were the largest ever given by the Chinese regulator. We saw Alibaba, also a Chinese tech giant, having to curtail its media assets in an effort to reduce its sway on public opinion. Then the DD IPO, which was much anticipated, just days after the listing, the government put this company under investigation and removed it completely from the App Store, obviously sending that share price down quite drastically. So the implementation of these reforms last year was fragmented. It created a lot of uncertainty in the markets, and obviously markets do not like uncertainty, and that sell-off was quite severe. However, this has created an attractive entry point for investing into China. And this is kind of what you can see on the graph on the right-hand side of the slide. This shows the valuations of Chinese internet stocks versus US internet stocks. And you can see valuations were converging somewhat towards the end of 2020 to 2021. But during 2021, those valuations diverged in that sharp sell-off that we saw due to tech regulations. We do think a lot of the risk is now priced in, but regulatory reform will continue. But we're quite encouraged that the government signaled at a conference in December 2021, so last year, that it would increase its focus on economic stability and not just implementing reforms. So we hope that reforms will be implemented in a more carefully considered and better communicated manner. Right, so I touched on the fact that China is underrepresented in many benchmarks. Index providers have historically excluded onshore China listings from these benchmarks, and that's really that's where this underrepresentation started. So at the moment, in the MSCI All Country World Index, which is a really popular global broad-based index capturing both developed and emerging markets, within this index, China only represents 4% of the equities within there, whereas the United States represents 61%. And this is quite different. You get quite a different picture when you look at those countries' share of GDP, so basically the size of those countries. And while we don't think that the MSCI All Country will ever represent share of GDP perfectly, we do expect over time that those all country weights should converge to economic exposure, particularly again as China's market opens up, as the onshore listings become more fully included into these benchmarks, and also as the financial sector develops. At the moment, inclusion of China in major indices such as the All Country World Index and also the Emerging Market Index is capped or restricted using an inclusion factor, and that is because of historical restrictions in ownership of Chinese domestically listed companies. But we'll touch on that on the next few slides. So I just wanted to kind of take some time to discuss the different types of Chinese equities, because there are a number of different names thrown out there, and it's important to know what these different share classes refer to, and particularly what you are investing in when allocating to China. So historically, domestically listed Chinese companies were restricted by foreign, these were restricted to foreign investors. And so what you saw happening is a lot of Chinese companies listing elsewhere. So a lot of Chinese companies listed in the United States on the NASDAQ or New York Stock Exchange, and a lot also listed in Hong Kong on the Hang Seng. The companies that listed offshore are typically your more globalized Chinese companies. If you think of kind of China Tech, those sorts of companies typically listed offshore, particularly on the New York Stock Exchanges. And then domestically listed companies would typically have been, more domestic focus and well known to the Chinese consumer, but probably less well known to a foreign investor. So this has resulted in kind of these different share classes. So you have your domestically listed equities, you have your equities listed in Hong Kong, and we have equities listed in the United States. Shares listed on the domestic Shanghai or Shenzhen stock markets are often referred to as A shares. So these are companies incorporated in mainland China, listed on local markets and priced in renminbi. Historically, they were not available or accessible to foreign investors, but now they are becoming more and more accessible, firstly through the Stock Connect programs, which give foreign investors access to specific A shares that are listed on those programs, or if a foreign investor has a qualified foreign institutional investor license. And just to mention there that Sygnia does have a qualified foreign institutional investor license, also known as QFI license. And so access to these A shares is not an issue for Sygnia. We also do have access through the Stock Connect programs. Then there are also B shares, which are also listed domestically. These are similar, only difference is that they are priced in foreign currencies such as USD. B shares do not feature, the size is quite small and relatively insignificant. Then we get those stocks listed in Hong Kong. So 3 different types of shares or share classes in Hong Kong: H shares, P chips, and red chips. So your H shares are Chinese companies that are incorporated in China, or in mainland China, that is, but listed on the Hong Kong Stock Exchange. They trade in Hong Kong just as any other listing in Hong Kong would, and have no foreign investor restrictions. An example of an H chip, an H share would be something like Ping An Insurance Group, although it's worth noting that Ping An also does have an A share listing. And that's kind of something you do see with Chinese companies, is they may list on different exchanges kind of to give accessibility to different types of investors. Then we get a different type of share class called P chips. These are companies that have shares issued by Chinese companies incorporated outside of mainland China, but list on the Hong Kong Stock Exchange. These are companies either owned by private companies or private individuals in China. And an example of a well-known P chip is actually the likes of Tencent. Then lastly, we also have red chips. These are companies, these are very similar to P chips actually, but are owned or controlled by the Chinese state. And so an example of a red chip company is actually Lenovo. And then lastly, we have your US listed Chinese companies. And so 2 different types. The one is your N share and the other is your ADR. Sometimes these terms are kind of used interchangeably, but there is a subtle difference. So N shares are companies that are listed on a US stock exchange, but also domiciled within the United States. Whereas an ADR would be listed on a US stock exchange, but domiciled outside of the United States, in a region such as the Cayman Islands or similar. These are classified as Chinese companies in that the majority of their revenues or assets must be derived from mainland China, and they trade in USD and obviously have no investor restrictions. So an example of an N share would be Baidu.com or JD.com, and then Alibaba is a great example of a US listed ADR. Although once again, Alibaba also has a P chip listing on the Hong Kong Hang Seng. Then I just want to draw your attention to the graph in the center of the slide. This kind of shows the relative size of all these different share classes, and your A shares are represented in the lighter blue, and you can see how they dominate the Chinese equity market when it comes to market cap and size. Also worth noting is that there are relatively fewer US listings, but their size is still quite significant despite fewer listings. And that just speaks to kind of the size of some of the companies listed in the US, such as the likes of Alibaba and other tech giants. So I mentioned that many benchmark providers, such as your MSCI, your S&P, or your FTSE companies, have a cap, or they limit A-share inclusion in their benchmarks. And this is largely because of the history of kind of A-share accessibility to foreign investors. So these benchmark providers cater to the foreign investor. When China's A shares were relatively inaccessible, they would have been excluded from benchmarks. But now that we're seeing China's domestic market opening up, A shares are now included in these benchmarks, although their inclusion has been implemented at a gradual pace. So starting off with a factor that is used to downweight each company that is a China A share. So at the moment, the inclusion factor is 20%, and this results in a China A share weighting within the MSCI Emerging Market Index of roughly 5%, which is what you can see in the first pie chart on this slide. However, we do expect that the inclusion factor, or this down weighting, will increase over time as China's market opens up further and becomes more accessible and more familiar to the foreign investor. And that's what you can see on this slide here. These different pie charts model what China A share weights will be like if that inclusion factor is lifted. So if you move along, to the next few pie charts, you can see when the inclusion factor lifts to 30%, to 50%, to 100%, which would be your full inclusion. You can see that China A shares in the red go all the way up to 21% of the MSCI Emerging Market Index. And along with this, we still have the China offshore exposure, which has always been there because that's the basket of companies that foreign investors always had access to. So that has always been there in the index. And then if you combine the offshore and China Asia exposure within the MSCI Emerging Market Index, you actually get quite close to 45% of that index. So you can just see, an incredible dominance of the emerging market benchmarks. But despite this dominance, investors still have relatively low exposures to China. And this partly comes because of the downweighting within benchmarks such as the MSCI All Country World Index, which many investors will measure their portfolios against. But it also comes down to a lack of familiarity with Chinese domestic companies. However, because of the historical restrictions on domestically listed companies, the China Asia market has been relatively insulated from global market ebbs and flows, and you actually find it's it's very uncorrelated to your global markets, and it's also uncorrelated to the China offshore market. So including your China A shares in a well-diversified portfolio can actually give a great source of uncorrelated alpha. It also allows for better risk management and more efficient allocations within a portfolio or alongside a portfolio's emerging market exposure. It's also worth noting that as the benchmarks include China more and more, and as foreign investors get more acquainted with domestic China, we expect allocations to China to increase. The graph on the bottom of the slide shows how Chinese equities have not been very accessible to foreigners right up until about just after 2016. But after that, there was a major jump in accessibility. And yet, despite the jump in accessibility, the portion of Chinese equities held by foreigners didn't jump to the same extent. It actually remained pretty much on track with historical growth. And so we do expect that to kind of increase into the future, especially as foreigners become more acquainted with China, but also as the inclusion factor used by benchmarks increases. So I mentioned at the beginning that we do think it's all about where you are investing in China. And it's important to know about the different share classes and whether you are investing in offshore or onshore Chinese equities, as they have quite different risk return profiles and can allow for better and more efficient allocations. But it's also about investing in the sectors that are positioned to do well. And so, with the major shift that is happening, with China moving from a manufacturing and industrial-led economy to a more advanced economy, we're seeing the services and consumer sectors starting to outpace manufacturing, and that's really what you're seeing in the graph on the slide. Ever since 2016, China's been reducing its excess industrial capacity, destocking housing inventories, and reducing corporate debt. This has all had an impact on growth and industrial production, and real estate have started to taper off. Alongside this, there have been structural reforms to promote more sustainable economic growth rather than rapid growth at all costs that was reliant on manufacturing, exports, and low-paid labor. Within this framework, household incomes are also starting to increase, and people are adopting technology as well at a rapid rate and improving their quality of life. The services and consumer sectors are benefiting as a result. A lot of growth is now seen in the services sector rather than manufacturing and agriculture as it was historically. We expect this trend to continue into the future, particularly as China moves to a more advanced economy. But if you compare China's consumer spending or household income to that of developed nations, you'll see that there's still quite a way to go, suggesting ample room for further development into the future. So the Chinese Communist Party has been relentless in their desire for economic progress, and this has come through in the data on growth. But China is also becoming a leader in many areas that are critical to returns over the next decade. Just as an example, technology and innovation in China is central, and I already mentioned their dominance when it comes to Chinese companies being holders of key patents. But just another example when it comes to 5G. So 5G rollout in many countries has been quite slow, has been stalled, but China has just gone ahead and built more and more of these 5G base stations, while the rest of the world kind of slows and falters in progress in this regard. And also China, at the same time, has already launched a satellite to test airwaves for potential 6G transmissions. And they did this in 2020. So they're just moving on to the next, innovative technologies and gaining a competitive advantage in many key innovative sectors. This slide just highlights some of the government initiatives over the past decade or so that kind of speak to this desire to achieve competitive advantage in high growth innovative sectors, but also drive growth from an innovation standpoint. So all the way back in 2010, the government announced certain emerging industries that it would seek to support and accommodate, really to try and drive growth and competitive advantage in these areas. So this included energy efficient technologies, next generation technologies, biotech, advanced equipment and manufacturing, new energy vehicles, and new materials. Then moving along to 2015, we saw the launch of the Made in China 2025 initiative. So this spoke a lot more to the move from high growth manufacturing to high quality manufacturing. And again, the strategic emerging industries were in focus there. Moving on a year, China released its 13th five-year plan, again focusing on technological advancements, research and development, and the support of key strategic emerging industries. For those not familiar, the five-year plans are central strategic roadmaps for the Chinese Communist Party, kind of outlining social and economic initiatives over the next five-year period. So the 14th five-year plan was also launched last year in May, and this kind of takes us all the way to the end of 2025, 2026. And so this is a key document to look at rather, when kind of mapping out where China is moving towards in the future. And before we get into the 14th five-year plan in a little bit more detail, I just want to also note this idea of common prosperity, which has come up a lot in kind of, particularly in China's president's speeches over the last 3 years or so. Just a recent one from the World Economic Forum described this process, and I'm going to quote from his speech. Described it as a rising tide lifting all boats. Everybody will get a fair share from development, and development gains will benefit all people in a more substantial and equitable way. So that describes what this idea of common prosperity is. It's pro-growth, but it's a more equal, well-distributed growth. And then just the quote on the slide, kind of speaking to the focus that China's government will have on this ideology, saying that they are working on all fronts to deliver this goal. So this is something that's going to be an important feature when it comes to China's economy. It has been over the last year or so. A lot of the reforms being implemented are in the spirit of common prosperity, and it is something that we will see over the next few years. So taking a little bit of a closer look at China's 14th five-year plan, just because that's kind of going to define the next 5 years or so within China's economy. So again, we saw the plan outline technological areas of focus. This included AI, quantum computing, semiconductors, and aerospace, among others. Research and development was also a key feature within this plan. And alongside this, we also saw an initiative to kind of strengthen domestic demand, but also open up the economy to the world. So this is known as dual circulation. And yeah, that kind of speaks to improving well-being, national security, and demand internally, while also opening up capital markets, expanding the Belt and Road Initiative, and kind of getting more integrated into globalization. Just speaking to the internal support again, China did announce plans to increase its domestic content of core components and materials to 40% by 2020, and then all the way to 70% by 2025. So that just means that China is looking to bring more of the supply chain of production in-house into China and kind of extract more value within the various steps of the supply chain. Just to mention a few other key initiatives from the five-year plan. I already mentioned the strengthening domestic demand. There will be more support for both rural and urban development in the spirit of common prosperity as well among those two different regions. Improvements to well-being will be supported, particularly as China's population ages and more support is required when it comes to healthcare, but also as in other health and well-being areas. Sustainable development was also discussed in the five-year plan, And this kind of speaks to some of the commitments that China has made over the past few years when it comes to the climate and carbon neutrality. They have goals of achieving carbon neutrality by 2060 and to peak carbon emissions by 2030. So that is really another focus within China's economy. And then lastly, supporting and enabling business environment. This again kind of speaks to strengthening the domestic economy, as well as support national security. So we can't speak about China without at least touching on some of the China-specific risks. So I've already mentioned some regulatory risks that we saw coming through in 2021, last year. A lot of these were focused on improving social outcomes, improving financial stability, and protecting national security. Antitrust regulation was also a focus, but again, this seeks to support a more equal distribution of growth. So your tech sectors were most highly affected, but what we are positive about and what we are kind of encouraged by is that the government at the end of 21 signaled that it would take economic stability into account in a far more considered manner. In addition to regulatory risk, which is expected to still be there, there are also geopolitical risks, particularly when it comes to the US-China relations. Although this is somewhat abated with the Biden administration coming to power, that rivalry and that tension between the two largest economies in the world will naturally persist, specifically because of their differences when it comes to trade, ideologies, and defense issues. China's decoupling from the global economy also resulted in a few supply chain issues. And then we're also paying attention to issues around Taiwan and its independence at the moment. Corporate governance risks are also something that people become quite concerned with when investing in China. We do think that corporate governance issues are improving, but the government is still quite involved and has quite high influence over both public and private companies in China. And that kind of links in a bit with the regulatory risk issue, but that is something still of concern. There may be other risks in addition to this. I haven't listed them all, but that just gives you some of the things we are looking at and considering when thinking about China. And with these risks and with these drivers in mind that I've mentioned, we do still believe that China presents an attractive opportunity at the moment, albeit with some short-term volatility. With growth slowing, we believe that there is value to aligning to specific sectors in China's economy that are set to benefit from the new growth path rather than the old drivers of growth and expansion, such as industrials and manufacturing. We've therefore kind of grouped different sectors in different buckets. We've grouped certain sectors into what we call an old economy, and certain sectors into what we call a new economy. So within your old economy, we have sectors such as industrials, materials, utilities, and energy companies. Within these broad level sectors, there still are some pockets of opportunity. So if you think about high quality manufacturing or advanced materials, those do still present, in our opinion, pockets of opportunity. But as a whole, we do not find companies in these sectors to be particularly attractive at this point. We've also classified the real estate and financial sectors in the old economy, really speaking to kind of the historical investment in real estate that is tapering off and issues with the history of China's banking and finance system. But again, there are pockets within these sectors that can still benefit and are expected to still benefit from China's new growth path. So in the case of financials, we still like insurers, as we believe that that area of the economy is still set to do quite well, particularly as the Chinese consumer strengthens. In the new economy, however, on the right lighter green side of the slide, we have our consumer discretionary and consumer staple sectors. These are both set to do well, as you can imagine, as China's GDP per capita increases, as China's household incomes rise and consumer spending increases. In addition to just the strengthening of the Chinese consumer, we're also seeing consumption shift towards more local brands rather than foreign ones, which further increases support for these companies domestically. Then we, of course, include the healthcare sector as well. With China's population aging, healthcare expenditure is going to rise, and government support for healthcare will also rise as it aims to improve the health and well-being of its population, again, within the spirit of common prosperity. But secondly, the government has also shown great support for innovative sectors within the healthcare industry, such as biotech and genomics. Lastly, we include technology and communication services within the new economy. I don't think that will come as a surprise to anybody, but we see that kind of barriers to adopting new products and services in China have been low, and the Chinese consumer is very willing to try and trust new technologies, which has created a great environment for growth and innovation within China. The digital economy is planned to be about 10% of GDP in 2025, and the government has certainly shown a lot of support for technological advancements and growth in the sector. Despite this, the technology sector did see a lot of the volatility, particularly last year, but we still think it is an attractive place to be. And just looking at the slide, you can actually see the technology sector being a star performer nonetheless over the last 5 years and 10 years. So this graph just looks at the performance of the various old and new economy sectors that I just discussed over the past 5 and 10 years. These are broken out from the MSCI China Index. And yeah, I don't think it's to anyone's surprise that information technology is at the top there. But what we are encouraged by is that a lot of your new economies are making their way to the top of this graph. But we do not believe that this is necessarily the indicator of how things will go going forward. But we believe that kind of structural changes within the Chinese economy are really the driving force behind future return expectations. And so this is only the start of the story, really. But looking at China's 5-year growth plan and kind of the shifts it needs to take to move to a more developed economy, we do think that those new economy sectors are set to perform exceptionally well. And that is why we've created this fund. The fund, the Sygnia China New Economy Global Equity Fund, looks at picking sectors rather than stock picking. This is in an effort to keep fees and costs low while still positioning the fund to outperform within China's changing landscape. And so we're still quite careful about where we invest, but keeping costs low for our clients, which, as you all will be aware, is an important part of Sygnia's ideology. This next chart shows the sector breakdown of the Sygnia China New Economy Fund. This was as at December 2021, December last year. And as you can see, the consumer discretionary sector forms the largest part of the fund, followed by communication services at 16%, consumer staples at 15%, information tech, at 14%, and then healthcare at 10%. You also might be somewhat surprised to see some of the old economy sectors within this slide, within this fund. So financials at 10%, industrials, materials, and utilities all feature within the fund. And the reason for this is that while the chart on the slide shows kind of the top level sector classifications, we base our sector selection on the most granular level of the classification framework. So we drill right down to economic activity, and we'll analyze and include companies based on that economic activity. For example, within the utilities sector, you can see there that utilities are about 1% of the fund. So within the utilities sector classification framework, we might have gas utilities, you might have water utilities, you might have electricity utilities, but then we also have renewable electricity utilities, and that's the kind of subsector that we do include in the fund, and that's why you are seeing an exposure to utilities within the Sygnia China New Economy Fund. Similarly for financials, as I mentioned, we think that the insurance sector is poised to benefit from increased consumer spending, and that's why you see financials there at 10%. That is mostly your insurance companies, which some of which are quite large and form a significant portion of the fund. Then on the right-hand side, I've compared the Sygnia China New Economy Fund to the MSCI China Index and the MSCI China A Index. And I think it's worth just pointing out here how it is so important to know where you're investing when allocating to China, because in the case of the MSCI China and MSCI China A, at face level they sound like similar benchmarks. You're getting China exposure through both, so one might just assume that you're getting quite a similar exposure to China if you invest in MSCI China or MSCI China A. But you can actually see, and just by this just by the sector comparison, that the sectors are quite different between the MSCI China and MSCI China A. And if you also were to break out performance and risk, you'd see that there would be very different characteristics between these two benchmarks. So what are the differences? Well, the MSCI China A index focuses, as the name suggests, on your domestically listed Chinese equities, so your A shares, whereas the MSCI China index, the middle column, includes your US listings, your Hong Kong listings, as well as the A share listings. And similar to the structure of the emerging market index that we discussed a little bit earlier on, the domestic A share inclusion within the MSCI China fund, the MSCI China index rather, is also included at a down-weighted factor, using that same inclusion factor of 20%. And so the MSCI China is actually heavily weighted to offshore China, while your MSCI China A focuses solely on the A shares. And interesting to note, the MSCI China A you see a lot more of your old economy sectors coming through in that fund. You'll see higher weightings towards industrials and materials, and then your MSCI China, which is more focused on offshore China, has more of the consumer discretionary communication services companies. So yeah, that's interesting to kind of bear in mind. When it comes to the Sygnia China New Economy Fund, this new fund sits to some extent somewhere in between the MSCI China and MSCI China A. We also include US listings, we include Hong Kong listings, as well as A share listings. But we do not have an inclusion factor, or we do not downweight the A share within our fund. And this is because we do have access to A shares through the Stock Connect program, as well as through our QFI license. And so for us, there was no need to downweight this kind of group of Chinese companies. And so, yeah, the Sygnia China Fund kind of sits somewhere in between those two funds. So a little bit more detail on the fund itself. So I already mentioned that we look at specific sectors that we believe will do well with China's new growth path. These are sectors within what we have defined as the new economy. And we do this in an effort to provide a China fund that is positioned well for China's new growth path, but still is priced competitively for our clients. We do not limit our A-share inclusion, and this is largely because we have the QF license required to access A-shares. We were the second asset manager in South Africa to be approved for this license for China. The fund consists of 150 of the largest companies, the largest Chinese equities, measured by free float market capitalization. We do include a cap on an instrument level of 10% when we rebalance the fund. To ensure that the fund is traded without any issues, we do also apply some other screens and may exclude companies if we don't believe they possess enough liquidity within the market. We also exclude companies that are on the US sanction list, as well as those companies that are close to their foreign ownership restriction. So despite China's market opening up, there are still some restrictions in place. So one of those is that foreign ownership as a percent of total ownership of any given Chinese listed company cannot exceed 30%. And so as a company may be reaching that 30% limit, it becomes more and more difficult to trade. And so we would exclude companies that are getting too close to that limit. Yeah, then just on the right-hand side, I've given the top 10 holdings. You can see Tencent, which I'm sure we're all quite familiar with, being the largest holding in the fund at the end of December, and then a number of other well-known names. And you can see some of the large China A shares coming through there, such as Quechamutai, the third largest company within the fund. The table beneath just shows the split between A shares, H shares, and N shares, and you can see, yeah, kind of a general split between those. Then taking a look at the options available for investment. So we have two classes of this fund, an A class and a B class. The B class has no performance fee attached, whereas the A class has a performance fee of 20% outperformance of the benchmark, the benchmark for this fund being the Shanghai Composite. And then your management fees are given there, 70 bips per annum for the A class and 79 bips for the B class. If you're familiar with our other thematic funds, such as the Sygnia FANG Fund, the Health Innovation Fund, or the Fourth Industrial Revolution Fund, you'll notice that the class structures and pricing is exactly the same. So if you are familiar with those funds, you'll be familiar with kind of the structure of this one as well. Great, so that concludes the presentation this morning. I'm just going to stop sharing my screen and take a look at the questions. Okay, so there are some questions around the performance of the new Sygnia fund. We only launched the fund in November last year, so a long performance history isn't available at this time, but we'll try to follow up with you with some indication on that. Questions around holding the Class B in a tax-free savings account. Yes, that should be possible as there's no performance fee attached. Question on, does the fund mainly index track, or does Sygnia plan to research and invest under a fund manager? So we don't plan to research invest under a fund manager. As I kind of mentioned, we look to pick sectors and include the largest companies within those sectors rather than stock pick and look at the fundamental data. Then a question on, given the exposure to tech in China and government regulation, is it not too soon to get in? So always a tricky one to talk about timing, but just looking at the regulations first. So the regulations are warranted, they're going to be there for the next few years as China moves from emerging to a more advanced economy, and also as it develops in the spirit of common prosperity. So these shifts are necessary. Bear in mind, they are often there in the interests of consumers and smaller businesses in kind of an effort to give a more even playing field and bring China's economy up to international best practice. So while there might be short-term volatility, I think the intention of these reforms is really to position China for more sustainable long-term growth, which is definitely worth bearing in mind. And I think important to note is that the government did signal that they would look at improving economic stability going forward. So we hope that implementation might be better communicated and have less of an impact on the market going forward. When it comes to timing, it's a difficult one. I mentioned that we do hold the Emerging Asia Satellite within our global balance funds. During the sell-off of last year, created an attractive entry point for investment. But it's also worth just bearing in mind, we speak to a lot of asset managers in South Africa, all of whom are very familiar with China and China tech because of our exposure to Naspers and Prosus, which in turn are heavily exposed to Tencent, China's largest tech company. So, South African investors are actually quite familiar with China and China tech. And I think consensus view from what we're seeing is that most managers are quite comfortable with a large exposure or an overweight exposure to Naspers or Prosus. So that's how a lot of funds are already positioned. We're positioned with an overweight at the moment. So at the end of the day, there's most likely going to be that short-term volatility, but an attractive place to be for the long term, we believe. Then, are we comfortable with company data and accounting standards in China? I think it's worth noting that this is improving along with corporate governance. A lot of companies are listed in the US and Hong Kong, as we've discussed, and where they do so, they're required to adhere to those accounting standards. So you have really good kind of best practice accounting standards being adhered to in your offshore listings. And similarly for onshore listings, China's accounting standards are quite strict. They're relatively detailed, and also non-compliance is very severe. So we think that it is something that is improving, and companies that don't adhere to these standards are dealt with relatively severely. But that being said, this fund doesn't look at stock picking. We don't look at the fundamental data, but rather we're picking sectors. And so accounting standards do not have a direct impact on maybe the structure of this fund, although they may have an indirect impact. And then I just want to check time. I think we have time for one last question, and then we'll end it there. So another question is Sygnia worried about China growth slowing too far? So I think key to that is that the government has indicated that it will support growth China is already embarking on a looser monetary policy into 2022, while central banks around the world are tightening. GDP growth has always been a major measure for the Chinese government, and I think despite the targets being removed now, they will still always kind of measure performance against GDP, and GDP will be held quite highly. So I don't think the government will allow GDP to drop off too far. And that being said, GDP will include all sectors of the economy, so it's going to include that massive manufacturing and industrial sector that's definitely tapering off. But that's why we believe this fund is better positioned in the economic slowdown, because we're trying to find those pockets that are still still have the potential to see outperformance and higher growth despite GDP overall broadly slowing down. Great, so I think that's all we have time for. Thank you so much for joining us this morning. I hope you understand the fund a bit better, understand the China market a bit better, and thank you for your time. Cheers.